All right. I want to say welcome to everyone for today's webinar. I got lots of people registered for this one. I think a lot of people are seeing what's going on in the market, seeing what's going on with the election, and really excited to talk about what's going on in the real estate market, what's going on in the multifamily market in particular. Today's going to be really exciting. I'm looking forward to going over a lot of data points. Hopefully, if you're a nerd like I am and you like to look at data, we're going to talk a lot about data and we're going to try to paint a picture and have a story around the data as well, as far as what we're seeing, what our opinions are of what's going to happen with the market and where things are at. So gear up. Get ready, grab yourself a drink, grab yourself a cup of water. We're going to dive right in. I'm going to try to keep this around 40 to 45 minutes. Definitely leave some time at the end for a Q&A, but let's go ahead and get started. So real quick, if you want these slides, shoot us a text, 281-559-7061. Just text us your name and say, hey, I'd like the slides from tonight's presentation. With your email, we'll make sure we send these right over to you if you want to look at some of the charts and data that we'll be sharing tonight. Just a quick disclaimer, this webinar is for education purposes only and should not be considered legal accounting or investing advice. We're just here to educate you and help you make better investment decisions. Of course, we always advise you to consult with your attorney, financial advisor, or CPA for any legal matters. A little bit about us. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. Headway was created to help build and protect the wealth of busy professionals. Our mission is to offer investment opportunities that provide cash flow, equity appreciation, and tax benefits to help you achieve financial independence and to help you achieve your financial goals. We have a lot of experience in real estate and a lot of experience in commercial real estate with a focus on apartments. We've been through different market cycles. Sid started investing in real estate back in 2011. Got into the multifamily space as a passive investor in 2014, 2015, and became a full-time owner operator in the multifamily space late 2017, early 2018 with his lovely wife Anam. And I got into the real estate space back in 2017 in the single family space, did that for about 2 years and transitioned over to the commercial multifamily space right at the end of 2019, beginning of 2020. And I guess you can say the rest is history. And then last but not least, our CFO, CIO, Umar Nakvi. He has a lot of experience in the finance space and a lot of experience in the apartment space as well, having worked at a large property management company here in Houston. He's a numbers guy and he's the perfect blend of numbers and operations. So he's a huge, huge component of our team and the success that we've had. So this is our core team here. And we are focused on providing the headway difference to all of our investors. So we have a little over 440 million of assets under management, about 2,800 plus units, and we shoot for 25 to 30% target returns. And we try to make sure our investors have a great experience when they invest with us. Not just the focus on the money, but to make sure they're getting educated, to make sure they're getting updated, and that they feel confident in their investment decisions. A few testimonials on here from some of our investing partners. It's always nice to hear good things when investors are happy. So always great to add these to the slides and some case studies as well. These are the types of properties that we typically like to offer to our investors. We've got everything from newer properties built in the 2018, 2019, 2020. And we've got some older stuff built in the 70s, 80s as well. We've done a little bit of everything. So now that we're through all the housekeeping, let's get into it. Tonight's topic, Q4 market update for multifamily investors. So we have a lot of people that registered for this webinar. This is always one of the more popular series. I try to do a Q1, or I try to do like a 2025 beginning of the year. I'll do one of those, do a Q2, Q3, and finally Q4. I can't believe we're at the end of the year already. Thanksgiving is 14 days away, give or take. Christmas will be here before you know it. So we're at the end of the year. It's time to kind of look back and see what's happened in 2024 when it comes to commercial real estate in the market. And it's also time to make some predictions on what we see based on what the data is telling us. So let's dive right in. But it's impossible to talk about this stuff without talking about the elephant in the room. And the elephant in the room is who won the election, right? So regardless of which side of the coin you on, it is completely irrelevant. The real estate is still going to be there. The investment opportunities are still going to be there, right? So, but what is really important in the investment space, whether you're into stocks or crypto or real estate or businesses or whatever, is do we have clarity on who's in charge, right? Once we have clarity on who's in charge, usually that leads to volatility declining in the long term, right? There's, of course, some initial reactions that happen. When one side wins, you'll see some reactions in the market. When the other side wins, you might see different reactions in the market, right? And there's always a little bit of early volatility, which we're going to talk about here right now. We're seeing that now that Donald Trump is the president elect. We've seen some crazy stuff happen over the last, it's been a little over a week since that announcement's happened, right? So first, this was taken a couple hours ago. I screenshotted this myself. The S&P 500, right? The S&P 500 just exploded once the election results came in, right? And 4.5%, which is what this was at around 2 o'clock today. Doesn't seem like a big number, but the S&P 500, that's huge, right? So almost a 5% gain, and it was over 5% for some time as soon as the election results came out. So the markets are obviously very bullish on where they think they're going to go for the foreseeable future. Bitcoin, this is a hot topic again, which I always find kind of funny because when I was getting into commercial real estate back in 2019, 2020, the crypto craze was going on, right? Everybody was talking about Doge and Ethereum and Bitcoin and all these other altcoins and different things. And it kind of died down for a while because crypto really collapsed and fell apart and everything dropped off in 2022, I believe. And it's back up. It's hot again, right? The Thanksgiving table talk this year, mark my words, is probably going to be somebody talking about, man, did you see Bitcoin's at 90,000? Maybe it'll be at 100,000 before then. Who knows? But as of today, it did go above 90,000 for a bit. But as I took the screenshot earlier today around 2 o'clock, since the election results were announced, we're up 33% when it comes to Bitcoin, which is just insane, right? Everyone knows how volatile cryptocurrency can be, but the markets are clearly very bullish, especially when you have the president-elect announcing that he wants America to be the Bitcoin capital of the world, and all the people that he's appointing in the office are very pro cryptocurrency, very pro Bitcoin. So we're seeing this explosion right now, which will eventually lead to Ethereum growing, which will eventually lead to some of the altcoins like Doge and some of the other coins that get traded in the market growing. So we're about to go through very likely a bull market again, all due to the election. And then you've seen stocks, right? We've seen individual stocks. It was announced the other day that Elon Musk is head of the Department of Government Efficiency, which is a coincidence because it stands for Doge, which is his meme coin of choice. So we've seen Tesla explode since that, right? There was some EV tax credit disappearing announcements that came out today, which kind of lowered Tesla a little bit, and a lot of companies that are in the EV space, like Rivian, was down I think 10 or 11% today. But regardless, Tesla exploded in the last week. So clearly, the market is very bullish, right? The equities market's very bullish. The crypto market's very bullish. But what about the real estate market, right? What have we seen in the real estate market? Now, the good thing about real estate is I don't have before I go to the treasury, I don't have some fancy charts to show you about how real estate shot up overnight, right? Real estate is a very slow moving vehicle, which is why I love it. Like I love the fact that I can't pull out my phone, at midnight like you can with crypto and say, man, what's going on in the market? Because crypto is 24/7, 365. The market never closes, right? Stock's a little different, but real estate doesn't move that fast, right? And I like that about it. I like that I can park my capital somewhere, and if it's going up, it goes up slowly, and if it's going down, it kind of goes down slowly too. So you can kind of know what's going on. You can really feel it in the moment without having to necessarily worry about it. But the one thing in the equities market that we do watch that does impact commercial real estate is the 10-year treasury. We've seen a massive spike in the 10-year treasury, really not necessarily since the election was announced. That did play a role in it, but it really started when the first rate cut happened, right? So when the first rate cut happened, and then when the market started to predict that Donald Trump would be the president-elect, the 10-year treasury took off. And some people are like, well, you've probably heard this from some of your maybe friends or family members, or maybe you're in real estate. People are like, well, we just cut interest rates 50 basis points. This was back in September. Why the heck are interest rates up, right? It doesn't necessarily make sense. Well, a lot of it has to do is that interest rates are tied to the treasuries, right? Interest rates, especially in commercial real estate, are tied to the 10-year treasury very closely. So since we've seen the interest rate cut, markets have gotten more excited. People have gotten more bullish. People have decided they wanted to start selling bonds. When they start selling bonds, they start moving into equities. The value of the treasuries go up, right? So until we sort of see that slowdown and the excitement kind of wears off, and we're experiencing this volatility right now because this is all super fresh. It's only been about a week. we expect the 10-year treasury to continue to go up. There's even talk of it potentially touching up to 5%. Well, what does that mean for real estate? That means that financing deals is going to get more expensive short term. Now, the good news is as you can see, the 10-year treasury, this doesn't seem like a long period of time, and it's not. It can be can drop very fast as well, right? So we saw the 10-year treasury down below 3.75 late summer this year, right after August and September, right? And then once they did that first rate cut in September, it took right off, right? So I expect to see some volatility for the remainder of the year. Some forecasts and some analysis, some analysts, some smart people that are way smarter than me are predicting that it will touch potentially 5%. I don't want to go that far and say that's going to happen for sure, but with at least one more rate cut being likely, people are assuming another 25 basis points in December, and definitely potentially more rate cuts in 2025, depending on what the president elect sort of tries to influence from the Fed. Even though it's technically not a government agency, they have they technically don't follow the direction of the president or any of those other parties. We'll see, but it's really going to depend on all the economic data, which we're going to talk about today. So let's talk about the economy, right? Now that we've talked about the election, we kind of got that out of the way. How's the economy doing? And this is really important when it comes to multifamily, because if you don't understand how the economy is doing, it makes it challenging to make decisions when you're looking to invest, whether you're an active investor or a passive investor, right? And it helps with your decision-making process so that when you're reviewing a business plan for a multifamily deal, you can understand, does this make sense based on what's going on with the economy, right? So a couple of things. Let's talk about inflation, right? This has been the hot topic for the last really 2+ years. And the good news is that we have seen inflation drop. You know, inflation was up around 9% for the CPI a year and a half ago, give or take, a little over 2 years ago, I guess you can say. And we've now since come back down to a much lower number, right? So we've seen all items at around 2.6%, right? And some data came out today. Some new PPI data came out today that was basically in line with expectations. It was not something crazy. People were saying it's reaccelerating. It's not. I don't. In my opinion, it's not reaccelerating. The headlines love to pick up on that stuff. It was basically in line with expectations, and you have to remember that we're now comparing that year over year based on inflation dropping. So in 2023. If you look at the end of 2023, inflation was already dropping. So now that we're comparing it year over year, that percentage might look a little higher, right? So just something to keep in mind. But looking at the U.S. Consumer Price Index, the chart over here on the right, you can see that inflation's been basically pretty much in check for the last few months. Came in at 0.2%. This was a report from this week. It came in at 0.2%. This is as of today, right? So this just came out, 0.2% for October. So we're in November. It's always 30 days trailing, and the data came out saying it was 0.2, which is basically in line with where things have been, right? So we're not seeing this crazy volatility, 1.25%, 0.5%, all these other ones that were crazy. We're staying pretty consistent, which what we're waiting to see is some drops, right? We want to see some drops, but if you average 0.2 over a 12-month period, technically we're at 2.4%, right? So the Fed's goal is to get to 2%. So we're getting there, right? We definitely want to see some lower numbers. We want to see some 0.1s or some zeros or some negative numbers, but it's going to take time. Jobs. This is really important because the people that rent apartments need jobs, right? So where's the job market at? And this is something I have personally have strong opinions about. And there's reasons for that, but I just think the data is very skewed. Is the kind of the easy way to describe it. And part of the reason is if you go back and look, there were a few months ago, I think it was 2 or 3 months ago, a big report came out saying that the job data from last year was revised 800,000 plus jobs. 800,000 plus jobs. So basically, they said, hey, jobs are amazing. We've got this many jobs. And then a year later, they said, oh, wait, those numbers were wrong. Let's cut 800,000 of those jobs off. The issue I have with the jobs data is it's always wrong, right? So every month they come out with a jobs report saying how many jobs were added, how many jobs were lost, this kind of stuff. And then if you read the fine print and you kind of keep scrolling on the Bureau of Labor Statistics, it'll say, oh yeah, by the way, we got the last 3 months wrong. Here are the real numbers. And then a year later, they'll revise those numbers again, right? So it's like revision after revision. It's crazy when you think about it, but the headlines, right? The media is going to pick up on the stuff. And then we make decisions based off of some of this stuff as well. So the thing that I thought was very interesting is that this past month's job data that came out, I think it was about a week ago, showed that October 2024, we added 12,000 jobs. Look at all these other numbers over the last 2 years that we've been adding 900,000, 500,000 close here. And then we've been pretty consistently adding anywhere from 150 to 200 ish thousand jobs. And then all of a sudden, it's really close to the election, and they were blaming the hurricane that hit the Carolinas. They were blaming the strikes that we had, and it goes to 12,000. Really odd. Now, the other thing that you'll look at is if you look at this data and kind of peel back the onion a little bit more, is that a lot of these jobs are actually government jobs. Several of these months, 60 to 75% of the jobs that were added were government jobs. What a coincidence. So there's a fair argument to be made that a lot of this data is inflated, and you won't actually know what the real job numbers were till 12 months later, maybe even longer, right? I think the best thing you can do is, if you have a friend, if you have a family member, if you're a business owner yourself, you're probably feeling this in real time. If you're laying people off, or if you're hiring and you're like, man, why is there so much talent on the market right now? Seems like there's a lot of jobs out there, a lot of good people looking for jobs. That's how you can sort of feel it in real time. And we're owners, we're operators, we're constantly hiring people for our property management company. And I will tell you that what we've seen over the last 90 days is some of the best talent that we've seen in 2+ years, right? So people that are good, hardworking, well-qualified managers in the property management space that have never been available are now available. They've been laid off by their jobs. When you're seeing that real time, I trust that more than I trust this type of data, but it's something that we have to look at as we make decisions. Unemployment is another one that people talk about, right? So not only jobs, how many jobs are being created, but what's the unemployment number? The Fed really likes to keep unemployment around no higher than 4 to 4.2%. 4.1, they're still okay with. If it starts creeping up to 4.3, 4.4, 4.5, the Fed has a big problem with that because their mandate is to control pricing and keep job stability. Those are like really the only two jobs they have: price stability, make sure things aren't super expensive, and make sure people have jobs. Sounds easy. So, but it's not. So anything above 4% starts to set off the siren for the Fed, where they really have to start making decisions. Do we cut rates, which could stimulate the economy and essentially cause inflation, but it also helps create jobs, right? So, or do we leave rates high? Bunch of people lose jobs. The economy gets sort of suppressed, but it kills inflation. So they're in this weird sort of situation where they have to make really tough decisions. Some people thought the 50 basis point cut in September was too aggressive. Some people said it should have been higher. Some people said we should have just waited, right? So everybody has a difference of opinion. It doesn't really matter which one's right or wrong. What matters is we're going to have to live with the results one way or another, right? So right now the job data is showing 4.1%, which is the same as it was around September. So it's staying pretty consistent. But if the Fed sees an uptick in unemployment, right, they're already looking at this 12,000 jobs, which is why they cut 25 basis points again, in my opinion, on this past meeting. But they're looking at this number very closely because we have to make sure Americans have jobs. And you'll see here too, this is another chart you can pull up by just typing in job openings from the Fed. This is directly from the Fed's website, Bureau of Labor Statistics, and you'll see for September 2024, which is the last report, you can see the amount of job openings is declining, right? So it's just, again, more data to really make sure that you understand what's going on. There's not as many people hiring right now, and that's because the economy is slowing down. So I tried to rush through that. That took about 15 minutes, but a lot of good data, right? A lot of things to really be considerate of when you're analyzing your investment decisions, when you're looking at the economy. But what's going on in the multifamily market, and how do these things that we've been talking about, the state of the economy, how do they impact commercial real estate? We're gonna with the focus of trying to focus on multifamily, right? Most of us here are multifamily investors. We're either passive investors, and you invest with us at Headway, you invest with other operators, or you're an active operator yourself, and you're living and breathing this every day. Or maybe you're a capital partner, you're a vendor, you're in the lending space, right? So you're living and breathing this every day. How's this impacted the multifamily market? What are we sort of seeing in the data today? First things first, I want to talk about supply and demand. This is really important. because understanding supply and demand can kind of tell you what's going to happen. It can be a sort of a foreshadow on what's going to happen at the commercial real estate market, or at least in the multifamily market for the next several years. So this is from our good friends over at Marcus and Millichap. They put a lot of great data out. They put a lot of great charts out. So you see these blue charts, they're always from Marcus and Millichap. You'll see here, we have this is for Q 3 2024, we had 163,000 apartment units that were delivered, right? Which is about in line with the US median annual unit completion of 161. So right in line. But we had 191,000 that were absorbed, right? So absorption just means that the apartments were actually rented. So out of all the new things that were delivered in Q3, it all got absorbed and then some, right? So it's really important to show that absorption is still really strong, is what this graph is saying. People are still renting apartments. And then we're going to talk about why, or our opinion on why. I think we all know here how unaffordable buying a house is right now. And that's why new construction apartments and even value add apartments or older apartments are still being rented very strongly. So we're still seeing a lot of really strong supply, well, really strong demand, I should say, and the supply is actually easing up. We'll talk a little bit about Houston here in a second, because we have had a lot of deliveries this year throughout the U.S. when it comes to multifamily. But as you can see, we've still had really strong absorption in overall for the year for 2024. There's only the Q1 right here where you see net negative, where there were more completions there than there were absorptions, right? So really still a good sign for the supply and demand side. And you'll see here talking about how the housing shortage continues to mount. So part of the reason, in our opinion, and we agree with Marcus and Millichap, that the absorption is really strong, is that there's a housing shortage, right? There's not enough affordable housing up there. There's not enough houses for sale that people can actually afford, and interest rates are so high. I think they're creeping up around, they're definitely above 7%. I saw something earlier today that said they might touch 8% pretty soon. Right now, buying a house just doesn't make a lot of financial sense. Even if you have the money, you have to ask yourself, do you want to lock yourself into an 8% mortgage? Of course, you can refinance and get out of it long term, but is it worth the headache? Should you just stay where you're at, or should you just rent and wait, right? So this is part of the reason why we're seeing a lot of absorption, right? You'll see here the important line is for sale single family inventory. So you'll see the inventory of for sale homes has just continued to decline over the last 20 plus years, right? And you'll see the amount of apartment completions has upticked, especially since we've seen a lot of demand in the apartment space, and we've seen absorption continue to uptick with it. So as long as absorption's there, we're going to continue to build. But there is a slowdown coming, and a lot of that has to do with cost, and we'll talk about here in a second. How has vacancy been? So this is something that's really important. If you're in the multifamily space, we want to make sure our apartments are rented, right? Vacancy tells you basically how many units are empty. Well, you'll see here the national average right now for vacancy for this past quarter for the multifamily space is 5.6%, which is right in line to where vacancy normally is, just kind of industry wide as a standard, which is, again, a good thing. And we're actually seeing it start to descend, which, again, is a good thing. If vacancy is dropping, that means we're absorbing more units. We don't want vacancy going up. That means we have more empty apartments. So, again, all Q signs here showing that we are starting to see, we're still seeing really strong demand in the apartment space. And the national apartment vacancy rate here on this chart is forecasted to actually tick down as completions drop. So you'll see here in 2024, we've completed over 520,000 multifamily units. That's not 520,000 complexes, that's units. So each unit counts as one, right? 520,000 units have been delivered in the US, this is not just Houston, this is in the United States of America, right? Next year, based on the data that's been pulled for permits and what's forecasted to actually be delivered, we're going to see a massive drop. We're going to see 110,000 less units, which is a huge drop, right? Compared to the 520. But we are forecasted to see that vacancy rate drop because of that, because there are now going to be less units. And this chart continues to go down. I think there's a slide here we'll show what 2026 and beyond looks like. The amount of completions that are forecasted over the next 3 years is expected to drop, which is only a good thing if you own existing multifamily over the next 3 to 5 years. Again, still really strong demand, and the fact that we're seeing strong low vacancy is a good thing for multifamily. Why is vacancy low? Why is there strong demand? Well, this chart kind of tells you all. So this is from our friends over at Newmark. This is actually from a Collier's report that were put out, but this chart's from Newmark. This is actually from Newmark. I'm sorry. So it says here, this is an interesting chart to look at. Economic trends favor renting over ownership. The year-over-year spread between home ownership and rental costs increased 7.6%, reaching $1,203 in the third quarter of 2024. And obviously, elevated by high interest rates, renting remains notably the most cost-effective option compared to home ownership. So, what's really interesting here is the average effective rent in multifamily in the United States is $1,800. That's everywhere in the United States, right? Not just Houston. Okay. But the average mortgage payment monthly today is $3,000. That gap is massive. There's a $1,203 difference, which is the second highest on record compared to Q1 2024, right? So the gap between owning and the gap between renting is massive. And what has that done for renter sentiment? It has really crushed it. So this other chart shows that renter sentiment shows lack of hope in purchasing home near term, right? So this is crazy. So all renters are on the blue line. People under 50 years old are on the gray line. And this shows the probability of buying a home within the next 3 years based on a survey, right? They see that probability declining. So young people, people that are coming out of college, early 30s, people that are starting a family, they're seeing a decline in their sentiment on their ability to go out and purchase a home within the next 3 years. They lack hope, they lack faith, right? So that's really, really why the multifamily space is doing so well when it comes to that vacancy rate. People are still living there because they're renters by necessity. They're not necessarily renters by choice. This other chart, same thing, shows that this is from Redfin, which is I'm sure a lot of people here know Redfin. They do a lot of great residential real estate. They have a residential real estate website that's very similar to like Zillow, but they also provide a lot of really good data. If you're not following them on the data side, they do some great stuff as well. It says the U.S. is adding renter households faster than homeowner households. Again, just showing here the blue is the renter households and the red is the renter. I'm sorry, the blue is the homeowner households and the red is the renter. So again, this data is all saying the same thing from different sources. We now have more renters than we have buyers. And there's a lot of things that we talked about previously are contributing to that, right? The fact that Americans don't want to pay 7 and 8% for interest rate. The fact that there's no inventory on the market. Things that are on the market are not affordable right now. So there's a lot of reasons for it, but it continues to show all good signs for rental real estate if you own single family housing or if you own multifamily assets. One of the things I found really interesting as I was going through this data and sort of researching this rent to own thing is this is a chart. I don't have all 75 on here. The 75 largest metropolitans in the US that are showing the rent rate versus the home ownership rate. And I found it really interesting that there's actually 3 cities on here from Texas. I didn't highlight Austin because we don't really focus on doing deals in Austin. But I did highlight San Antonio and Houston. And San Antonio here, I believe, is number 10 on the list. So out of all the people that live in San Antonio, 41%, if you round up, of them are renters. The other 59% are buyers. And Houston is not far behind. Houston's number, what is it, 17 on the list, I believe. 39% of people are renters. 61% of them are homeowners, right? So you'll see here between the some of these more unaffordable places, I think everyone knows how expensive LA, San Diego, New York, these California places are. California's on here 1, 2, 3, 4, 5 times. No surprises there. New York, no surprises there. Hawaii, no surprise there. But to see the San Antonio next on the list and Houston on the list as well, again, we are focused on buying assets here in Texas personally. That's what we do here at Headway. The fact that we have a large renters market is good for us. That means we have more renters available that can potentially live in our properties, which is a good sign. Let's talk a little bit about the Houston market. So this is a statement here from the president of the Colliers Multifamily Market Division. So Colliers is a multifamily brokerage. They're a multifamily shop. They provide all kinds of different types of commercial real estate opportunities, not just multifamily. But their president, Danny Rice, said this is his sentiment, his sort of overall statement when it comes to the Houston market. He said, after nearly 2.5 years of declining occupancy, the past 2 quarters have resulted in positive occupancy growth for the Houston multifamily market. This activity, coupled with continuing rising rents and the recent half-point reduction in the short-term federal funds rates, has provided a positive outlook for the road ahead. Although transaction levels remain low, expect this to shift as we transition into 2025, as investors feel more comfortable with where current market conditions are today and are heading tomorrow. So the president of the Colliers that put this together, he feels very bullish on the Houston multifamily market. Let's look at some data that they've put out and see some reasons why. So some market indicators, just some good numbers to kind of know. You can see the Houston unemployment rate a little bit higher than the national rate of 4.1%, but nothing drastic when it comes to unemployment. You'll see here some other data, just interesting stuff to look at. Again, amount of inventory units based on quarter 3 2023, quarter 2 2024, and quarter 3 2024. You'll see that number stayed pretty stable around that 750,000, but you will see the new supply dropping, right? So you've got new supply going down. Q3 2024, it went from 7,000 in Q2 to 3,000. So we're seeing a decline in the amount of new multifamily apartments being built and delivered in the Houston market today. The good news is it all got absorbed, right? So out of that 3,000 new units, 3,900 were absorbed. That's not all new units, but it's also existing units. And our occupancy actually went up compared to last quarter, still a little bit below this time last year, but we're at 88.6%. And again, that's for the market. That's an A class, B class, C class, and D class, stuff that we don't typically touch. It's just for the market. Units under construction, 17,000. Again, that number is heading down. And then the average monthly effective rent actually went up, which is, again, I think this is a product of the amount of demand we're seeing in the Houston market for rental real estate. Rents actually creeped up $4. So this time last year, they were $1,280. This year, they're $1,284, and it went up $4 from the previous quarter in Q2 2024. So all good signs, things we want to see in the Houston market. Over here on the right, you see some market fundamentals. So it says Houston's overall occupancy rate rose 20 basis points for the prior quarter, but is down 20 basis points year over year. Overall, the average monthly effective rent, again, we covered all this, is at $1,284, and the Class A units increased to $1,751 from $1,741 in quarter one. So Class A saw a big uptick here. We also talking a little bit about cap rates. So we have a whole nother webinar series. You can find it on our YouTube channel. If you don't know what a cap rate is, go check that out. Just go to Headway Capital's YouTube page. We did a whole series on cap rates maybe 2 or 3 months ago. Really interesting stuff, so you can understand what it is. But talking a little bit about the median cap rate in Houston. Houston's multifamily median cap rate actually decreased by 60 basis points to 5.6 during the third quarter. Overall, the same period, the U.S. median cap rate rose to 5.8 from 5.7, while the Texas median cap rate remained consistent at 5.6. So we're right on line with the Texas median cap rate at 5.6. And on an annual basis, Houston's median cap rate increased to 5.6 from 5.2, and the state's cap rate climbed from 5.6 to 5.6 from 5.2, and the country's cap rate rose from 5.8 to 5.4. So in multifamily or in real estate in general, you don't really want your cap rates to be going up. You want them to be going down. That's how value gets created. And that's not, cap rates cannot be controlled. But it's good to see that the cap rate decreased by 60 basis points to 5.6 in the third quarter. So if you look here on the chart, the Houston chart, obviously things have been going up since the Fed started raising interest rates, not only in Houston and in Texas, but nationally. When debt gets really expensive, cap rates are going to go up because demand goes down, right? So when cap rates go up, values go down, and properties are cheaper and they're less valuable. But the good news is I think we're starting to see, we're starting to turn a corner, is the way I like to describe it. We're seeing now Houston, which is this light blue line. Cap rates got up to about 6.5, but they're starting to decline. And in my opinion, Houston is always a little bit ahead of the national economy. I feel like we don't feel the bad as bad as it sometimes is. And when the good things happen, we always feel them a little early just because we're a very blue collar economy. A lot of hardworking people that work here, medical center, oil and gas. You got the Port of Houston, a lot of jobs, right? So the good news is return of corner. We've seen a 60 basis point decrease. We want cap rates to go down. When cap rates go down, the properties that we own become more valuable. There's no other way to describe that, right? So the good news is that they're heading in the right direction. I think we'll continue to see cap rate compression over the coming years as the market kind of corrects itself, especially with the Fed continuing to cut interest rates. We will see some volatility at least early, but I think we're going to work ourselves out of this thing in the next 12 to 18 months. Median price per unit. So what are people paying? Again, just some more interesting data over here. Houston's median sale price per unit fluctuated during the last few years. The current one's about 131K, which is up 2% from the previous quarter, but down 3% year over year. Again, if cap rates are going up, values are going down, so it all makes sense. Texas reported a year over year decrease. Again, no surprises here. We know the market's we're in a buyer's market, not a seller's market. Prices were going down, and the state's median price per unit rose 6.5% during the quarter, which is good, to 147,000, but it's still down 3.5% year over year. So, again, just some good data to kind of see here. We're seeing median price per unit kind of fluctuate between the quarters, heading up from quarter 2 to quarter 3, just a hair. It's something just to continue to watch. Price per unit is important, but it's not the end all be all. Same with cap rates. I think you have to make an educated decision based on all the data, not just one particular thing. Let's talk about vacancy, which I know we talked a little bit about a minute ago, but this is more nationally. I'm sorry, this is more when it comes to Houston, not nationally. We talked about national vacancy a minute ago when we looked at some of those Marcus and Millichap slides. This is just for Houston. So Houston vacancy improves quarter over quarter as demand boosts fundamentals. So you'll see here the national vacancy rate and the Houston vacancy rate is basically right in line. We're at that 5.6%. And again, we go back to look at one of the other charts, we're right in line where everything is sort of nationally. So the long-term average is around this 5.5, which is grayed dotted line. And then the current vacancy rate in Houston is 5.6. We're just a hair above it. I think the national average might be 5.5. So good news is we had a peak at 5.9% in the first quarter of 2024, and then it's continued to decline since. Again, there's a lot of absorption right now. People are renting apartments because they cannot afford to buy a home. Also, rent growth. So rent growth decelerates quarter over quarter, year over year. So we saw a little bit of drop in rent growth. So that's one of the things about Houston that we felt over the last 12 months is we haven't seen a lot of tremendous rent growth, and that's very similar, song you'll see or tune you'll see across the U.S. There are some markets that still continue to have strong rent growth in like the Midwest, very different markets, but in Texas we've seen a pretty much flat rent growth. I think Houston itself is either at 0 or negative 0.1. So again, basically flat. So quarterly rent growth from Q3 slowed to 0.7%, while year-over-year growth decelerated to 0.9%. And year-over-year rent growth is expected to rise in 2025 as concerns over new supplies ease. So one of the things that can push down rent growth that you don't really think about has nothing. It isn't always interest rates. People think, oh, interest rates affect rent growth. Yes and no, right? What really impacts rent growth besides demand is the supply side of things, right? If there are a lot of new apartments being built, too many new apartments being built, that's going to push down rent growth because those apartments, those builders, they want to fill them up and they want to sell them. Usually, sometimes they keep them, but usually they want to fill it up and sell them. Well, the way they fill them up is by offering concessions, is by offering discounts. They'll say, hey, you get 1 month free, 2 months free, or they're just not charging market rent, right? Maybe market rent is $1,500 for a 1-bedroom a property, and they're charging $1,300 or $1,350 for the first year, right? They do those things to fill up the units. They need to get them to 90% occupancy so they can sell them. That's usually the goal, right? So we've seen a little bit of softening in the rent growth side because of that. But I continue with we talked about absorption and we talked about how strong that is, but we also talked about deliveries dropping. We're going to expect to see rent growth continue in 2025 because we're seeing supply easing, right? So delinquency is another one that a number we keep a very close eye on. So delinquency is basically when we're not talking about apartment delinquency, we're talking about loan delinquency. So we're talking about people that are delinquent on their loan payments, right? So talking about somebody that owns a property and they can now no longer pay it. So this chart is actually a national report. This is not just for Houston. So it's really important to highlight first. This is nationally, right? And there's some different things here to look at. This chart talks about office, it talks about multifamily, it talks about industrial, it talks about retail, and it talks about retail excluding malls. And it talks about delinquent watch lists. We'll talk about each one of these charts. So this on the left is the Moody's CMBS delinquency tracker. And the thing you'll notice that really stands out the most is the sector that has the most delinquency when it comes to CMBS debt or that type of loan product is the office sector, right? And I think that's no surprise. Most people that watch real estate and that read the headlines know that office is in a serious depression right now. It has been since COVID. It's had a little bit of recovery, but for the most part, office is still in a really tough spot. I don't think it'll be like that forever. If you're somebody who's very risky, or you like taking risks and you want to buy a building at 60, 70, 80% off, office is where it's at, right? There are empty office buildings in the city of Houston that you could buy, big, beautiful, 300,000 square feet that are completely empty, and they'll sell it to you for two, three, $4 million, depending on where it's at. There's a price per square foot that they charge, right? Depending on the vintage. But the price that you can get some of these really nice office buildings is crazy right now. And it's 50% or less compared to what you would pay several years ago before COVID, right? So we've seen a lot of delinquency in the office space because people have these assets and they don't have any tenants. They can't pay their mortgages, right? Now let's compare that. We're not going to go through all these. Let's compare that to the multifamily space. The multifamily is the gray space, right? The gray line at 2.3%. So we've seen 9.8% for the office space. The retail space is right below that at 8.7, but multifamily is still in a really good spot. Now, industrial is in the best spot. It's done really well since COVID. People are building stuff and shipping it online. Amazon, right? That's done really well. But the multifamily space is still doing pretty good, right? So we're 2.3% delinquency, which is way lower than I thought it was going to be personally. I thought we were going to see more delinquency. And we'll talk about that here in a second. This over here on the right is debt past original maturity still outstanding. So again, this is very similar. You can see the different office class, and you can see where different loans are in the process. So there's $187.9 billion of loans that are outstanding right now. And you'll see in the office space what percentage of them are delinquent, what percentage of them are on the watch list, which percentage of them are in special servicing, meaning they're potentially going to that foreclosure place, and then, or which ones of them are not troubled at all, right? So out of $187.9 billion of loans still outstanding right now in the commercial real estate space in general, what percentage is what? So in the multifamily space, you'll see only 2.6% of the loans are delinquent, which is really interesting. Again, not as high as you thought it would be, but we do have a very large percentage of loans on the watch list, right? So these are loans that are either barely paying their mortgage, they're like just getting by, or they're delinquent just a little bit, right? So and then they catch up, and then they get delinquent and they catch up. So they're kind of on that watch list where they don't fully fall delinquent, but they get really close every month, right? So they're on that watch list because they're not hitting their DSCR, or their debt service coverage ratio. Then you've got some loans that are in special servicing. They're already going, they're starting to have issues, and they're trying to renegotiate with the lender. And then you've got 15% of loans that are not troubled at all. They're just going through business as usual, right? So really interesting to see different loan products and where they're at. A lot of loan products on the watch list in every sector, especially in the multifamily space. But the next highest is, of course, in the hotel space. They got hit pretty hard after COVID, have bounced back pretty well since. And then you've got other spaces as well. And the largest amount of delinquent loans are, of course, in the office space. Nearly $1 trillion of commercial real estate debt faces potential trouble, and it's 529 billion matures in 2026. So this is really an interesting chart. You'll see here over the next 3 years are kind of highlighted here. These are potentially troubled loans by maturity. So we have loans maturing in 2024, which is this year, loans maturing next year, and loans maturing the year after. You'll see what percentage of them are, or how much, I should say, not percentage, how much of them are in the apartment space, how much of them are in the industrial space, office, and retail. So you'll see here, this year, we've had quite a large number of loans in the apartment space that were in maturity year, right? That were potentially in trouble. But I don't know about you, I haven't seen blood in the streets, right? I haven't seen mass headlines where there's foreclosures left and right, keys being handed over to the lender. I think most operators and most lenders have been working together to sort of solve their issues if they're having issues with their loan, so that the property doesn't get foreclosed on, right? So it's been really interesting to see, and I think we'll see the same thing going into next year. But it is also interesting to see going into 2025, that number gets cut in half, right? The amount of loans that are maturing in 2025 that could potentially be in trouble is going to drop. So personally, this kind of leads me to believe that I think we're going to see a very tight window. And I don't think it's going to be like 90 days or anything like that. But I think for the next 6 to 12, maybe a little bit longer months, you could potentially see some properties that are distressed, that are in pre foreclosure, that are in foreclosure, that were taken back by the lender. There's going to be some really unique opportunities over the next 6 to 18 months. And we're already seeing some, but I don't think there's going to be this massive tidal wave. I think it's going to come down to really good operators that find unique opportunities based on their relationships. And I think there will be some out there, but you just have to know where to look. Supply, we've kind of hit the nail on the head with this pretty hard already. Supply is expected to sharply fall year over year. And we talked about this earlier during the presentation. So it says as of the third quarter of 2024, almost 600,000 units were projected for delivery, making a 40.5% increase compared to 2023, but supply is expected to decline by 15% in 2025 and 53% by 2026. That's a huge number, right? So by 2026, we're going to see a 50% decline in deliveries in supply that's coming online. Well, there's a lot of reasons for that. Construction costs are still really high, inflation's still really high, and we slowed down in building apartments. Permit pulling got slowed down pretty drastically in certain markets over the last year and a half, 2 years, because there's been a lot of deliveries coming on, and those deliveries take several years, right? So if you had a property get delivered in 2024, you likely started working on that project in 2021 when money was free and when real estate was doing really well, right? So it's just now coming to market. There's a lag effect when it comes to supply, right? It takes a long time to find a piece of land, put it under contract, get all the permits and entitlements you need to make sure you can build there, find the GC to work with, put up the apartment complex, get it leased, and then finally sell it. That's a process. That's a 3-year process, right? So 2026, we're going to see a slowdown, and that's because people started slowing down in 2022 when money got expensive, right? 2022, 2023, we saw a drastic drop in the amount of how expensive it is to do deals. So we're going to start feeling that in 2025. We're going to start feeling that in 2026, and supply is going to drop. And when supply drops, that means that we don't have new units coming online. That means they don't give out concessions. That means we should see rent growth, which is what we've been talking about today. So overall, I think we're right on the money here when it comes to timing. You got about 10 minutes left. Is now still a great time to invest in multifamily? I personally think yes. And obviously, I like buying things when they're on sale. That's just my opinion. Whether I'm at the grocery store, I'm at the store, I want to buy things when they're on sale. It's not always the most comfortable. People often invest with the I'll call it the FOMO sort of strategy, fear of missing out. You see that with cryptocurrency all the time and stocks, like, oh no, so and so's up. I got to get in before I miss out, right? Well, when that happens, typically bad things end up happening as an end result, right? We don't want bad things to happen. So we want to buy when things are distressed. We want to buy when things are on sale, and we want to sell when things are better. I don't want to say buy low, sell high, because of course that is the overall thesis, but we can't time the market, right? We don't know when the bottom is and we don't know when the top is. All we can try to do is buy good deals based on where we're at in the market and what we're seeing in all this data. So why is now still a good time to invest in multifamily? Well, the Fed is going to forecasted to cut interest rates at least one more time in December to 25 basis points. That means we're going to have a full 1% reduction, and that'll put the Fed funds rate in the low mid fours, right? So we'll be more attractive when it comes to debt. We just got to get over all this volatility that we're seeing in the equities market and the treasuries. That'll take a little bit of time to kind of work through, depending on if we go through any type of recession or not, right? We're seeing discounted deals compared to, of course, several years ago. We're finally starting to see pricing back personally where things were prior to COVID, right? We're seeing C-class properties and B-class properties trade back at a point where they actually make sense, which is really exciting to us. And we think we're going to see this window for a very short period of time when things are on sale, right? Single family homes are still drastically overpriced. Just can't get over that enough. And I don't know how fast that's going to get corrected. Of course, if we see interest rates drop, that will spark demand. And if demand is sparked, that won't necessarily mean there's a price decrease, right? If somebody waved a magic wand and interest rates went from 7% to 4%, well, why would prices drop? That doesn't make sense. More inventory would hit the market. More people would decide they want to sell. That could push pricing down a little bit because there's more inventory, but there's also more buyers. So it kind of washes itself out. So I don't see a massive price decrease in residential real estate coming without some sort of other outside factor that I'm just not seeing right now. There would have to be something totally different that we're just not seeing that would cause all those prices to drop. So invest now, buy and sell later, right? That's really the goal, especially with the gap we're seeing now between renting and buying. We want to buy when things are on sale. We want to sell in 3 to 5 years when things are not on sale anymore and hand them off to the next person at a good price for all of our investors. So we still personally believe in multifamily. We believe in the strategy of buying buildings that people need. People don't need industrial. People don't need retail. People don't need hotels. Those things are great real estate investments. I've invested in those types of projects and they can make lots of money, but people always need a place to sleep. People always need a place to stay. People need a place to end their day at. And if you're buying single family housing, that's one great option. Or if you're buying apartment complexes, you're buying multifamily assets. That's in my opinion the more superior way to make sure you're buying with economies of scale. So that's my final statement for tonight. I want to open it up now for Q&A. And we went over a lot of data today. Again, if you want these slides, definitely text me. I'll put this code up here at the end. But if you're not a part of our private investor clubs, if you haven't signed up for and had a phone call with me, I want to make sure I encourage you to do that. You want to join the investor club so you get access to some of our events, our property bus tours that we do a couple times a year, and then our monthly tours and any other private events we've had. That invites only go out to people that have had phone calls with us. And of course, if we're doing a 506B opportunity, then we can only take capital and partner with people we've had a phone call with. So you want to make sure you join this club and sign up for a call. You can scan this QR code or text 281-559-7061 if you want these slides or you want to schedule a call with me. And you can reach me at investor@headwaycapital.us, or you can just send me an email directly, brian@headwaycapital.us, or you can go to our website, hit the sign up to invest button now, and get started on the process and get a call scheduled. So with that being said, I want to open it up now for Q&A. And if anybody has any questions about the data, happy to share my opinion, or if I missed something, I'm happy to go from there. Let's see, let me open up the Q&A box. Let's see here. Somebody had asked earlier, I think I kind of already answered that. Where do I think interest rates are going now that Trump is president? That's a good one. So we've seen some interesting things happen already in the market in the last week, give or take. Now, Trump can't wave a wand and cut interest rates. Technically, Jerome Powell cannot even be fired by Trump. There's sort of things that they can do to make it uncomfortable, and where there's a will, there's a way, I'll say, right? But he technically is its own entity. The Fed was created separately from the government so that the president couldn't directly, in theory, influence the Fed's decision-making policy, because their job is keep jobs, make sure the economy's good. And they don't want the president pulling those strings, right? This is sort of the checks and balances that are in the United States government, right? So it's not like Trump's going to come in on inauguration day and say, hey, we need to cut 200 basis points. Everything goes down 2%. Everybody's happy. Real estate opens back up and it's just back on the gravy train, right? Jerome Powell is still going to be there. He's still got a mandate, and he's still going to follow his decision making based on a lot of the data that we shared today is the exact same stuff. I'm sure he has way more data than we do, but a lot of the same things that we talked about today are the same things that the Fed is looking at and Jerome Powell is looking at and all the Fed chairs are looking at to make their decisions. Now, will Donald Trump's policy have an influence on interest rates particularly? Maybe. I think where you'll see more impact is in other areas, right? So like other areas such as the acts that were on step down, right? So the depreciation is a big one right now, right? I got a lot of questions about this. It's the end of the year. This year's bonus depreciation for year one is 60% max. It's on a step down until it goes away to zero. Next year it'll be 40%. In 2026 it'll be 20%. And it's gone after that. So Trump could come in and decide, nope, I want it all back, right? I want to go back to 100%. And he could go through the process of working with the House and the Fed to get those policies reversed and put that 100% bonus depreciation back year one, right? And that would be tremendous for all our real estate investors. If you could get 100% bonus depreciation, in theory, you could invest $100,000 and show $100,000 of paper losses if we have 100% the bonus depreciation. Doesn't always work that way, right? But it gets you a much higher number. Right now it's at 60, right? So If it's at 60%, your max is $60,000 of losses. So after they do their cost segregation study, it's probably going to end up being more like 40 to 45. Well, if it's 100%, maybe the max is 80 to 85, and you actually end up with that, right? 75 or 80. It's a much higher number to go from 40 to 70 or 40 to 80, but we need that 100% bonus depreciation back. There's no saying whether that's going to come back or not, but that's just an example of how the current administration versus the new administration could drastically impact our ability to not necessarily make more money, but keep more of the money that we make when it comes to commercial real estate. So we got some other questions in here. Let's see. I was surprised that the cap rates in the Houston MSA have already started to fall. Is that because there's more new A-class properties coming online, or is it because there are not many transactions in the B and C class space? I think it's a mix of both. That's a great question. There are new A-class properties coming online, and those will not stop. Once the construction machine has started, of course, any company can run out of money and kind of go into pausing stage. But these multifamily developers, they're rocking and rolling. You know, when an apartment complex is under construction, they're trying to finish that bad boy as quickly as they can because they want to get their money in and out. And those construction loans are no joke. I don't know much about new construction, but those loans are no joke. You got to get in, you got to get out. It's on a tight timeline, and they do not mess around with that. It's high interest, right? So that is part of it. There are new A-class properties being online that are affecting the supply and demand, right? But there are also not that many transactions in the B and C class space, right? There are deals. I feel like we're starting to see more deals now than we have in the last 6 months. Definitely a lot more deals than we have in the last 6 months. So we will see, I think, start to see cap rates sort of reflect that, but it's not an immediate overnight thing. So all good questions, but it is good to see that at least over the last quarter, we saw a little bit of cap rate compression in the Houston area. We'll see what happens in Q4 when all the data comes back out in January. When do you expect availability of homes start to increase or meet demand? That's a trick question. I think we'll start to see an uptick in the availability of homes on the market when we see an interest rate cut. Let me reflect. Let me back up. Not when we see an interest rate cut, when interest rates actually start to go down. So we've seen two rate cuts. We saw a 50 basis point cut and we saw a 25 basis point cut, but interest rates are still higher than everyone expected. That has to do with the treasuries, right? So we talked about the 10-year treasury. We need the treasuries to settle down. When the 2-year, the 3-year, the 5-year, the 10-year, when the treasuries all settle down and we don't see this crazy volatility, we'll start to see interest rates actually stabilize. We'll start to see interest rates drop. We need the 10-year to be in the threes. And ultimately, over the course of the long haul, we need it to probably be in the mid-high twos. But we really want the interest rates, the 10-year treasury to be around 3.5 to 3.25, maybe even 3%. You'll really start to see a lot of activity in the residential real estate space when that 10-year treasury goes below 4%. And then you'll really see activity when it goes below 3.5, 3.25. So we saw a lot of refinancing and some deals starting to make sense in the residential space as an investment when they were lower. You know, we saw on one of the first slides I went through, it's way back at the beginning, we saw the 10-year treasury got low for 30 days, and I know a lot of guys that were rushing to refinance right around here, right? So right around September-ish, we saw the 10-year treasury go below 3.75. It was around three and a, right, not quite 3.5, but with 3.6, 3.7. And I saw a lot of activity. Guys were refinancing, trying to buy some investment houses. They were ready to rock and roll because they weren't sure how long that was going to last. So they were like, we got to refinance right now. We got to go right now, because we know this is not going to last. We need this to happen again, but we need it to stay there. When that stays there, when it goes to below 3.5 and under, you're going to start to see deals make sense on the residential side, not in an investment space, but just for buyers. People don't want to pay 7%. They're okay paying 5%, 5.5%. I think that's where rates will ultimately end up over the course of the long haul, but we don't want to pay 7 and 8%. So we need the 10-year treasury to settle down. And that's going to help meet, once there's more inventory, you'll start to see more demand. But the reality is, in my opinion, is we don't have enough affordable housing in general. So, when we talk about housing, we're not just talking about housing as an umbrella. We're talking about affordable housing as well. I think we're a long ways away from that, many, many, many years. And I don't even know if it's a crisis we can ever solve. all we can do is do our part by buying, older assets, 1970s, 1980s, 1990s, renovating them and trying to make sure we're providing a quality product at an affordable price. That's how we do our part in solving the affordable housing crisis in America. Good question. Um, Kind of light on questions tonight. I'm kind of surprised. I think that's everything that we have for tonight. So it is 6 o'clock. I want to be respectful of everyone's time. It's been an hour. If you want these slides, please text us. I'm happy to share and put the number up on the screen one more time. Also, shoot me an email, brian@headwaycapital.us. I'm happy to hop on a phone call with you to get you on our investor list and also to make sure that you get access to our opportunities and you can actually invest. Just shoot me an email, brian@headwaycapital.us, or if you want the slides, 281-559-7061. I appreciate everyone attending. And I look forward to seeing you at the next one. Take care and have a good day.